Hello, my friends. Today is April 1st. My name is Joseph, and this is Markets Weekly. This past week was a really good week for markets. All major equity indices were up significantly and rallying almost every single day this past week. The S&P 500 ended the week up 2.5%, and the Nasdaq up 3.8% over the week. So what was driving the strong rally this past week? From my view, I think it comes down to three things. First, the panic in the regional banking sector is subsiding. Two, inflation, still high, is heading towards the right direction. And three, I think there are some market participants perceiving that there's more liquidity from the central banks flowing into the market. So let's talk about each of those three factors. Now, starting with the panic in the regional banks. Now, if you've been following me, then you know that my view has always been that that really just wasn't a big deal. The US financial system is much, much stronger today than it was pre-GFC. And at the end of the day, regional banks really just aren't that important to the financial system. And my expectation back then was this would pass, the market would shake it off, and we'd forget about it in a month or so. And I think that's in the process of happening. But let's track that process in real time, or as real time as we can do. So, as I noted before, the best way to track crises in the banking sector is to look at the Fed's weekly balance sheet. The Fed is the lender of last resort to the commercial banks. So when a bank gets in trouble, it borrows money from the Fed. And when it does that, we can see how much on a weekly basis. So we're all familiar with the discount window, and the discount window is how banks usually borrow from the Fed. They put up collateral and they get an emergency loan. Now, that number averaged about $105 billion last week, but as of last Wednesday, it came down to $88 billion. So it's declining. Banks are borrowing less from the Fed. That suggests that the liquidity crisis is ebbing. It's also worth noting, though, that the Fed's Bank Term Funding Facility, which is the new program they rolled out to offer loans to banks at very favorable terms, slightly increased a bit to $64 billion. Now, I suspect that there are some banks probably substituting away from the discount window towards the Fed's new facility, but all in all, the overall outstanding amount of emergency loans to the banking sector is declining. So that shows stability, and that's in line with the anecdotal reports we're hearing from the press. So I think that, I wouldn't be surprised if these emergency loans drop down significantly next week. One thing that is worth noting that I don't think is appreciated enough, though, is that the Fed's emergency lending facility to the foreign central banks is still not elevated, but it's still sizable. So last week we had the first $60 billion draw on the FEMA repo facility, and today that went down to about $55 billion. So it's slightly lower. That still suggests that someone somewhere outside of the U.S. has an emergency need for dollars. This is something I care more about because if you're in the U.S., well, the Fed can print infinite amounts of dollars and they can always paper any banking crisis over. But if you are a foreign bank somewhere outside of the US, say in China and France and Germany or something like that, well, foreign central banks can't print dollars. So it's possible that if you had some kind of crisis with offshore dollar banking, that's not something that can be easily papered over. And that's also the topic of my most recent piece here called Ameridollars. So what people may not often appreciate is that there are tremendous amounts of dollar deposits outside of the US. Now, in the US, dollar depositors have FDIC insurance, and if the worst comes to worst, the Fed, the Treasury, FDIC can bail everyone out like they did for Silicon Valley Bank. But what if you're a bank, foreign bank somewhere, and everyone who had dollars on deposit in that foreign bank suddenly asks for them back? you have a run on dollars in the foreign banking sector. If that's the case, well, that can't be papered over because foreign central banks can't print dollars. You could have a scenario where, dollar depositors, they're afraid that they might lose money from their dollar deposits, because if you're a dollar deposit outside of the US, you're not FDIC insured, and you are not fully backed by the US government. You don't have access to all these bailout facilities that they have. So if you're a dollar depositor outside of the US, there's real credit risk there. You really could lose your money if the bank goes under. It wouldn't be unreasonable for you to try to take your dollars out of that foreign bank and put it in the US, where at the end of the day, the authorities will bail you out. So this chart here from the Bank of International Settlements shows that outside of the US, you have about $7.5 trillion in deposits. That's a lot of deposits that are basically almost all uninsured. So, that's a substantial fragile point, I think. Just like Silicon Valley Bank had a whole bunch of uninsured deposits, and those depositors ran the first sign of trouble. So if you are a dollar depositor abroad, and you tend to be like a corporation or an institutional investor, because why else would, let's say, standard guy, average guy in a foreign country have dollar deposits? It's usually because you are someone active in international commerce or an internationally active organization. You have dollars. And so you could see those guys just pull money out if they feel their foreign bank is not secure, put that dollars within the US, and cause some kind of run on the offshore dollar system. Now, that's not happening right now, but it's a vulnerability because it's something that can't be easily papered over, whereas everything else really can. So again, this is the chart of the emergency FEMA repo pool. It spiked up a little bit, not a big number, nothing to worry about so far, but something to watch because, like I mentioned, it's something that can't be papered over. Now, the second thing we want to talk about that seems to be driving risk assets is that we had a pretty good inflation report. So the Fed likes the PCE as their measure of inflation, and it looks like that it's trending in the right direction. Here you can see that from a month-over-month basis, a few months ago it was 5.7, then it went to 5.3, now it's 5.0. So it's trending in the right direction. Obviously, 5%, much higher than what the Fed would like, but this gives the market hope that inflation is getting better, and in turn, the market will begin to think that maybe the rate hike cycle is going to turn into a cutting cycle soon. And we already see that priced into the market in a very significant way. So the best way to look at the market's expectations for Fed policy over the next year or two is to look at the 2-year Treasury. And you can see just right before heading into the Silicon Valley Bank incident, the 2-year yield was at 5%, and today it's at 4%. So in the matter of a couple weeks, the market priced out a significant amount of rate hikes and began to aggressively price in rate cuts. This is at odds with the Fed's own projections, the Fed's own projections say that they're going to keep rates at around 5% throughout the year. Market is saying that the Fed is going to cut rates later in the year. That's a pretty big gap, and we'll see how that's resolved. But when you have the PCE inflation trending lower, the market is going to feel more comfortable with its own estimate of rate cuts later in the year. And if the market believes that, well, the logical case for risk assets is to go higher in price, because everyone in the market today understands that when the Fed cuts rates, that's good for risk assets. And so if the market is expecting the Fed to cut rates later in the year, then it's perfectly reasonable for most investors to just go and buy risk assets. And we see that happening now. Again, like I mentioned before, the market has been very, very wrong on its outlook on inflation. There are really strong fundamental reasons, such as a shortage of labor, high wages, and the potential for escalating geopolitical tensions that could keep inflation elevated. But as of now, the market seems pretty comfortable with its beliefs. If and when it were to change its mind, that would push a repricing among many risk assets. Now, the third thing I want to talk about today is the view today that, part of the reason that equities are rallying is because central banks are easing again. They're expanding their balance sheet. So I don't think that's the right way to look at that. And I'll tell you why. So first, I think it's really understandable. Over the past 10 years, if you have a chart of the Fed's balance sheet and you have risk assets, they correlate really well. When I was at the Fed, we'd have many big investment managers, hedge fund managers come and show us this chart and say that, yes, obviously Fed expands balance sheets, so risk assets go higher. So when you have a lot of people who believe this, and then you see the Fed expanding its balance sheet because of the emergency loans that it's giving to the banking sector, I think a lot of people would begin to think, well, Fed expanding balance sheet, got to buy, and so everyone believes that, and stocks go higher. And some people would also note that it's not just the Fed that's expanding their balance sheet. There are other central banks like the Bank of Japan, who is trying to defend yield curve control over the past few months, and the PBOC in China. And Matt King of Citi has a good podcast on odd lots discussing this phenomenon. And he's absolutely right. As many market participants have noted, there is an empirical relationship between central bank balance sheets and risk assets. But I think it's really different when it comes to expanding your balance sheet in the context of an emergency loan to a bank. Now, let's look at these two lines here. These two lines, the first line is the red line, it's the Fed's balance sheet. And as you can see, towards the end of a couple weeks ago, we see it perk up a bit because the Fed is giving a few $100 billion in emergency loans. We see it expand. Note, though, that the blue line, which is deposits in commercial banks, that did not expand and actually declined. Now, usually these two follow each other very closely, right? So Fed expands balance sheets, that puts liquidity in the banking sector, which in turn increases deposits. There's some plumbing behind this. It's a bit wonky. If you're interested, I write about this in my blog post, Two-Tiered Monetary System, and I'll leave a link in the description below. It's a little bit wonky, but I think it's absolutely fundamental in understanding the financial system. So at a high level, when the Fed expands its balance sheet, oftentimes it also expands the amount of money available to the broader public. Let me give you an example. If I hold treasury securities and the Fed is buying treasuries, and let's say I sell my treasuries to the Fed prints money and buys out treasury. At the end of the day, in my bank account, I have more deposits. So the Fed, by expanding its balance sheet, increased the amount of deposits, the amount of what most people think of as money, deposits in a bank. So obviously that expands the amount of money held by the broader public. And you can think that if someone somewhere has more cash in their bank account, maybe they need yield, maybe they can't take bank credit risk, maybe they have $1 billion and that's far above the FDIC insurance limits. And so when they sell their treasuries to the Fed, they have some cash, maybe they go and they go buy corporate debt, maybe they go and they buy equities, maybe they go and buy longer dated treasuries and so forth. And you have this huge portfolio rebalancing impact that drives up risk assets. I think that's well understood by the Fed and by the market. But I think what is less well understood is that the Fed can expand its balance sheet and not have an impact on the amount of deposits available to the broader public, which is exactly what's happening here, hence the divergence between the expanding balance sheet and the amount of deposits in the banking sector. This is because the Fed is not interacting with the broader public, it's interacting narrowly with the banks. It's providing emergency liquidity to the banking sector, and the amount of deposits that the public holds, the amount of money, that the amount of stuff that we consider to be money, isn't actually increasing. So I think in this case, there's really no mechanical rebalancing impact. So I don't actually think that this plays a big role. It could psychologically, but ultimately, you have to have a real rebalancing impact for this to be sustainable. So I don't think that's valid. And on another note, I recorded a conversation with Peter Stella, who is a very well-known and someone that I respect a lot, a former official of the IMF and someone who is an expert in central banking with Jack Farley on forward guidance. And one of the things that we talk about is something called the fiscal theory of the price level. So what determines inflation? Now, I would encourage you to listen to it when it's out, but one of the topics that I want to impress upon people was that when you think about expanding the money supply, it's much more than just how much money do you have on deposit at a bank, or how much cash a bank has on deposit at the Fed, but sovereign debt, treasury securities are a form of money. So when you print a lot of them, you actually, empirically, you have an impact on the price level as well. But that's for another conversation. The last thing that I want to share with you guys this week is that, again, like I mentioned before, is that we have some serious geopolitical risk that's brewing that I don't really think is being appreciated. So we have this article here where President Xi Jinping of China is, again, strongly hinting that he is getting ready for war. Now, if you recall, President Putin also was saying the same thing before he invaded Ukraine, but everyone here just kind of shrugged their shoulders. Now, every country has red lines that they don't want to be crossed. For Russia, that was Ukraine, which was really, really important to them. And heading into the Ukraine war, there were many people in the West who were hanging out in Ukraine and saying basically, hey, maybe you should join NATO, which is obviously another way of saying, getting Ukraine, who was neutral, to be away from Russia. And not saying that justifies any attack or anything like that, but that was a red line for the Russians. And they, once it was crossed, they behaved in a way that they said they would. Now, China also has red lines, and they've been very clear what they are. So they regard Taiwan to be very, very important to them. And, well, we in the US, we sent very senior officials to Taiwan to hug their president. And today, their president is visiting the US. And, the US goes around the world just basically trying to isolate China from the European powers and so forth. So, there's a lot of things that are happening that are escalatory in tensions. And so you could eventually reach a point where you cross what someone else considers to be a red line, and that leads into military confrontation. That seems to be where we're heading, maybe not this year, but in the coming years eventually. So that has tremendous impacts on asset pricing. War is inflationary. It's going to have a flight to safety. That's something we have to keep in mind and follow very closely, because I think that is probably going to be one of the biggest drivers of asset prices in the coming months, if not the next couple years, because it seems like these tensions are not going away. Okay, so that's all I've prepared for today. Next week, I'm much less clear on what's happening. So my whole outlook for equities right now is fairly cloudy. I feel much more comfortable looking at things like rates and looking at things like currencies. Equities are always more emotional. So my core view has not changed. I believe inflation is persistent and that the Fed will carry out their plan of staying higher for longer. That suggests, in my view, a stronger dollar and higher interest rates. But that's something that I think will play out and how I'm positioned for. Anyway, thanks so much for tuning in, and I'll talk to you guys next week.